Welcome to the daily update, where I'll go over the action in the market for Monday, May 20th, and then we'll see how things look for Tuesday, May 21st. Kind of a quiet day. It was looking like we were just going to keep going up after last week. We hit some resistance and fell back. There were no economic reports to come out, so there was really no catalyst for the market to move off of, and there wasn't really all of that much happening as far as the stock market is concerned. We're still looking quite positive. We're looking overextended to the upside on all time frames, but you could also suggest that that's good momentum as well. Until we see some real selling into strength or some actual declines that change some of our indicators, we have to go with the idea that this is just showing good momentum. Before I get started, please know that I will be locking down the daily videos and only the daily videos starting Monday, June 3rd. I'm going to be launching the program, and I want to give folks that have a membership in that program, the first crack at the daily videos. These are the foundation of all the analysis that I do. All the other videos that I do are more supplemental. If you're not interested in a membership, but you do want to have early access to those videos, it will be $19 a month. The other videos that I do each week, those will be posted and made public as they're prepared. So that part won't change. If you want to talk to me about this, here is an email address. You can also put a comment either on the YouTube channel or on Rumble. And I have to click to get through this. So let's go back and talk about what happened, and then we'll go through the charts. We did have a higher open. Futures were positive. Jerome Powell actually was giving a speech on Sunday that didn't seem to have that much of an impact on the futures prices. We saw that follow through into the open on Monday. Prices climbed up above R1 at 53.11. We got above R2 at 53.19. Now the ranges were pretty small because of Friday's session. That was such an anemic day as far as movement that the pivot points for Monday's session were not all that wide apart. We ended up hitting resistance at 53.25. That's a nice solid round number. The market went up that high. That ended up, we didn't get quite to that level, but within a fraction of hitting that, and that's where we topped out. Prices then declined back below R2, R1. We got all the way down to the unchanged level. We climbed back above R1, danced along that for a bit, and then ended up closing slightly positive on the day. We were up 0.09%, almost unchanged, but since we were up slightly, it goes in the books as an up day. We're still below average with volume, which has been kind of a concern. We are positive in the short, intermediate, and long term. And then over the weekend, I did the weekly video. We're looking much better, even on the weekly charts. And it's about inflation and interest rates. Now, one of the big things that's going to come out this week are the FOMC meeting minutes. Not sure if they'll have anything really new that the market hasn't already dissected and discounted into the market. But you never know what can come out from that. We want to keep an eye on the geopolitical events. There was a helicopter crash in Iran, and the Iranian president died in that. And they're going to probably try to find some way to blame that on Israel, that it was foggy or something. And that could always has the potential to escalate things in the Middle East. So we just, again, want to keep an eye on that. Some comments that we can make: mega caps and semis actually had a pretty good day. We're seeing a little bit of the bigger stocks and more of the tech stocks continue to perform well, and that's really helping to hold up the market. And then JP Morgan Chase, it was down 4.5% after CEO Jamie Dimon said that the company's not expecting to buy back a lot of stock at these levels. So when your own stock is considered to be expensive, yeah, well, they ended up getting hit after that because buybacks are seen as positive. It takes some of the shares off of the market, making the shares that are available more precious. And also, it just looks good on the books. It's a way that companies can, I guess you could say, manipulate or maneuver things so that they're actually making money from their stock, not necessarily in their business itself. I also saw a post, I don't have it on here, that CEO Jamie Dimon is going to be retiring at some point from JP Morgan. And again, the things that he says, I don't necessarily hang on every word, but there's a lot of people that do. And we could be watching something for a long time, and then a couple of months after we're seeing something, he says it, and then all of a sudden it's like a revelation to the market. Well, that's why we want to kind of pay attention to what he says. On our short-term list, we still are pretty long here with the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the slope oscillator, the boom indicator based on 20 periods, and the RSI based on 9. So we haven't changed in that regard. We are still in the intermediate term looking at the CMB composite, the standard deviations chart, the TTM squeeze, the Sean trend meter, and then the 10-period moving average study for the S&P based on the highs minus the lows. We did drop off with the 200 period moving average study. Those are stocks inside of the S&P. That dropped down below that 80 level, but we're still looking extreme with the 150 and 200. Haven't changed this scenario. We'll see if anything happens this week when the meeting minutes are released, but it looks like that the Fed is going to keep rates higher for longer, and so they'll leave rates unchanged because inflation, although this last CPI report was friendly, we need to see more follow through from that. But we're not really sure of the idea of having rate cuts. We're looking at possibly September. And in the weekly video, that's when I went through the probabilities. And this changes all the time. And the Fed has also been decreasing quantitative tapering. So the market is really liking that. That's kind of what gave us some stimulus to go up near the end of April and into May. The dollar was up and interest rates were also up. This pressured stocks. We closed at 4.44% with the 10-year yield, where we had been at 4.42% after Friday's session. We're still inverted with the yield curves. Sentiment ticked down one. We're still positive at 64, where we had been at 65. We are developing a positive trend. The ADX is above its moving average and the green line is on top. With the slight up day, our bias is positive, and then the last 2, 3, 4, 5 days taken together shows that the momentum is still positive. We didn't have any economic reports, and we're not going to have any in Tuesday's session either. Very strange to have back-to-back days with no reports, so there's no charts to show. Here's some blog charts just to show you. It says the bear has a lot of catching up to do. This is when we hit a bear market like we did. I mean, we didn't know this at the time, but early January 2022, and then we bottomed in October of 2022, and then what the decline was, and then 1 year off of the lows, we're up about 21%. 2 years off of the lows, we're up 48.4%. And they're just saying that we're kind of below average right now, that the market still has more room to run based on other advances that we've seen after bear markets. This is Goldman Sachs looking at what they think the 10-year treasury yield will be as of right now. It's currently, 4.38%. They think it's actually going to decline down to 4.25%, but this changes all the time. Edward Yardeni did have a post where he says we're going to be between 4 and 5%, with most of the time being right around 4.5%. That's what he's anticipating. Then looking at an actual outflow when it comes to tech stocks, where this is the darling of the market and what a lot of people like to get into to buy low and sell high. Well, we're seeing money coming out. That's the light blue line. And then the 4-week moving average is actually dropping negative as well. We'll have to see, as the market's been improving lately, if these numbers end up changing. And then looking at what are a lot of people doing now, at least according to Bank of America, they're mostly in MLPs. These are master limited partnerships. And it's another way, kind of like a REIT, where you can invest in this and then it generates income and it's based on real estate. There's also bank loans, but this just gives you an idea. What's interesting now is a lot of money is coming out of tips, and I address that, and I will be addressing it later. These are Treasury inflation protected securities, and when we're in a rising interest rate environment, that's what people like to get into. When interest rates are coming down, this is what people do, is they get out of them, and so that's why we're seeing an outflow of this particular asset. Then 45% loss since April of 2020. It's the greatest 4-year loss in over 100 years. And of course, you must all remember what 1919 was like. That was right at the end of, well, World War I had just ended, and this was when the Treaty of Versailles came out. But we're seeing really big declines in the 30-year Treasury. Now, this is based on price. And this has not been a good investment over the last few years, pretty much since the COVID plunge. Economic surprises, we are showing that a lot of the economic reports are coming in weaker than expected. That's what they mean by negative data surprises. And the market's liking that, where if something comes in stronger, that's seen as negative. If something comes in weaker, that's seen as positive. So, and at some point that'll shift. You'll get to the point where bad news actually becomes bad news and good news is actually good news, but we're not in that kind of an environment right now. This is Deutsche Bank with their forecasts looking out as to what they think inflation will be, and they see it pretty much declining. When you look at the PCE, the CPI, and then the real areas that is focused on the core PCE and the core CPI, I didn't find anything on Twitter. There's not a lot of interesting things happening right now, at least that I could find. I do have some other additional charts that I'll show here in just a moment. Here's our intraday chart, where we did have a higher open and we got above R1 pretty quickly. We got above R2. This is the 53.25 level, a nice round number that the market ended up not being able to get above. And then we drifted from that level, actually came all the way back down to the unchanged level, bounced back up to R1, and then came down near the end, but did end up closing slightly positive. Here's our intraday chart. Not really anything too insightful there. We saw not a real big change from when the futures closed on Friday to where they opened Sunday afternoon and evening. We are seeing a little bit of an improvement here. Over the weekend, I was focusing on the value. The red line was above the blue line. Well, with the mega caps and the semis doing well on Monday, that helped the blue line to go back on top on the intraday chart. Seeing a little bit of an improvement here with our S&P growth to value ratio with this intraday chart. So our end of day charts where we had growth was up, where value was actually down. Mid caps growth was up versus being down with value, and it was up versus down with the small caps. So we're seeing a bit of an improvement here, but we want to see more than what we're seeing. And this is what I highlighted in the what to watch video, is something that is not looking all that positive right now, but this could change if we see a real insurgence of growth versus value. We are coming up a little bit with the small caps. We bounced up a little bit with the mid caps, and also showing a bit of an improvement with the S&P growth to value ratio, but we want to see follow through, continuation of this to turn more positive. We're coming up just to the high end of the rainbow now when we look at our ETFs of growth versus value. So that's just peeking its head a little bit outside right now. Discretionary did tick up, but is not necessarily breaking up right now, breaking to the upside anyway when compared to staples. Large cap growth coming back just right near, either at or near all-time highs. And the Wilshire also looking really solid for the time being, a broad market measure. Here's our trend where we have the ADX above the moving average and we're going back above 20. And the green line is now turned back up. So this is a positive strengthening trend. There's a short term also confirming that. And since this is short term, these lines move faster on this one. We're still seeing a real drop off in volume. That has been a concern. As the S&P has been going up, we've been seeing volume dropping off. And that would be a classic negative divergence. And of course, the perma bears are quick to point this out. And that may come into fact, let me back up. That may come into play at some point as a factor. But for right now, the below average volume doesn't seem to be a real concern. We just want to keep that in the back of our minds. Sentiment, here's the weekly gauge that we look at. We're coming in at 81.92. So now we're getting into extreme positive territory according to this. But this is a composite where it takes the AAII, that's the American Association of Individual Investors, the bullish percent index, the put call ratio, the active asset managers, and the VIX all together, which we tend to look at separately and puts them together into this reading. And then we have the insider transaction ratio. It's coming up just a little bit, but still pretty much in this neutral area. So this is when we look at this chart. This is the insider buying ETF, because this is a real strategy that a lot of investors use. They try to track what are the legal insiders doing, because they really know what's going on inside the company. And so these investors think, well, these guys have an inside track to information, so we want to be able to invest that way. And this has been bouncing back up as well as the market has been improving. The Ulcer Index, we're starting to get to a very low reading again here. And we don't have an updated chart here, but we're just a little bit above 3 with the latest reading from Investors Intelligence, slightly extreme positive. The VIX ticked up a little bit with the line chart as well as the bar chart. And this is what's interesting. We're actually seeing the VIX of the VIX pick up more. It had been giving very low readings, and now it's starting to go back up. The momentum, though, for the VIX continues to be down. And we were down slightly with the equity put call ratio on the daily chart. We're continuing to decline and getting near an extreme reading with the 5-period chart. The volatility risk premium ticked up just a little bit, but we're still underneath this band right here. So it's still relatively low. When we look at this fear gauge, you can barely see it. It ticked down just a slight amount there. And we're continuing to decline with this other fear gauge. Now, this is something new. Now, this is a chart. If you watch the weekly videos, I show this. This is the spread between risky and not as risky bonds. And when this is really going down, that just means that there's not a lot of fear. And I usually show a longer term chart here and just kind of see what the overall movement is doing. Well, on the next chart, this is something that David Keller from stockcharts.com has been really focusing on lately. And so I recreated a chart that he's been using, where on the top we have the S&P 500, and then in the middle we have this same adjusted spread here. This is actually what's really happening, is it's going down. But to make it make a little more sense, I inverted this. So you can see the S&P is going up and this spread is going up too. And we're coming back to some really high readings, or you could say low readings, from what we were seeing before. And then to try to bring it all together, this is the VIX, but it's also inverted to try to make all of these things line up. There are some people that really have a hard time with, okay, stocks are going up, so the VIX is going down. They can't seem to really calculate that in their head. So a lot of folks will use inverted versions of some of these charts because they want to see all of these charts moving in the same direction. And we're getting to a pretty low reading with the VIX as well. So right now, this is just showing that there's not a lot of fear in the market. Now, does that mean that we're pretty much at a point where fear needs to come back in? Possibly. But at the same time, we can stay up at these high levels, or low levels in this case, as the S&P continues to go up. But this is just an area that we'll be watching. Advanced decline line came down just a little bit based on price, rolled over a little bit based on volume, but we're still looking pretty solid overall here. We're also seeing where the new highs are beginning, or keep going up here. We're still looking positive with the 5-period and the 10-period moving average. The advanced decline ratio did tick down a little bit, but it's still positive. Accumulation distribution ticked down a little bit, but is still above an advancing moving average. The Chaikin money flow also ticked down, but is still looking positive. The Chaikin oscillator also ticked down, but is positive. We're still looking pretty good here with our cumulative advanced decline line for the NYSE. We're flat right now with the regular NYSE advanced decline line, also pretty much flat with our other new NYSE advanced decline line that's calculated in a slightly different way. When we look at common stock based on price, not really seeing a big change, but still holding up for right now. We're also actually broke out just a little bit higher here based on volume. And when we look at the cumulative advanced decline line for the S&P, still holding up quite well based on price and still showing strength based on volume. Our advanced decline line studies looking pretty good, even though we did decline slightly with the small caps because they're at the top end of the range. So naturally they have to start coming back down. Yeah, I'm cynical about this until we see some kind of a real sustained breakout. Here's our daily chart. Nothing really that changed all that much. We do have some potential overhead resistance if we continue to go up. If we come down, we might hit this pivot point and we're still above the 50-day moving average. On the bottom, we did continue to be below average with volume. The Stochc RSI is still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. All of the stochastics charts in the short, intermediate, and long term continue to be extreme positive. We're still looking just barely extreme with the boom indicator. We're kind of far away from that 20-period moving average. We're still looking good and not quite extreme when we look at the distance from the 50-period moving average, and we're still going up with the 200. So that's positive there. Looking at our double and triple exponential moving average based on 20 periods, we are going up. And we're showing some real strength. We haven't really come back down to these lines yet. With our 20 period, 50 period, we did decline slightly, and we just came down a little bit with our 200 period moving average study. The force index did decline, but it's still positive. Want to keep an eye, excuse me, want to keep an eye on the 20 period simple and exponential moving averages. As these lines continue to go up, that's more positive. We're still up in the +3 channel with our standard deviations chart. That's extreme. And then we're looking good here with the balance of power. We're above 0. We're also positive with the go, no-go system. We're positive with the highest high chart. And we're still looking extreme with the TTM squeeze. And to give you a little bit more context, this is a longer term look at this chart. It could still go higher than this, but quite often when I eyeball this, we get about up to this 150 level, and that's when it's starting to get extreme positive. Looking at our double and triple exponential moving average based on 50 periods, we're going up. As I've been saying, if the red line can cross back above the blue line, that would turn things back even more positive for the intermediate term. The CMB composite now has spent a number of days being extreme positive, even though it did decline. I want to keep an eye on the 50-period moving averages. We're getting kind of far above them now, but if we really see a decline, they may come into play. We're also watching to see the interaction between the red line and the blue line here. Typically, it's more positive when the blue line crosses above the red line. Equi-volume is still looking pretty good on top, and the ease of movement is going up and above 0. So that's positive. The Erin indicator is starting to flatten out, but it is still positive. We declined a bit with the S&P McClellan oscillator, but we're still going up with the summation index based on price and volume. We declined with the NYSE McClellan oscillator, but since both the McClellan oscillators are above 0, the NYSE summation index based on price and volume continue to go up. We're declining here, and this is a bit of a warning sign that we've been watching for a few days now. The Swenlin trading oscillator, it's still positive since it's above 0, but we're declining based on price and volume. But on a momentum basis, we still look good with the PMO, also going up based on price and volume there. We're coming down just a little bit with the PMOs that are rising. We're flattening, but still looking positive with the buy signals, continuing to go ever so slightly higher with the PMOs that are above 0. We still continue to be neutral with the Elder's Impulse system for the S&P. The parabolic SAR is still positive. The slope oscillator starting to roll over a bit, but it's still positive. The MACD continues to look more solid. So all of our oscillators, we're rolling over with the slope, still going up with the TSI. The intermediate term oscillators are positive, and the long-term oscillators continue to be positive. And we're looking at our moving average tree here. We're seeing some of these shorter term moving averages start to cross back above the longer term moving averages, which is positive. The bullish percent index still has not gotten above 70, but it has been going up, and this remains positive. The NYSE bullish percent index also continues to advance, and we flattened out with the NASDAQ 100 bullish percent index. We're still looking positive with the money flow index. We're declining, but still above 50, so we're positive with the ultimate oscillator. The vortex really seemed to kick back into gear here. The green line is going up, so that's positive. We're not extreme with the RSI 14. We're still extreme with the RSI based on 9 periods. We're still looking more positive with on-balance volume. We turned down with those stocks in the S&P above their 20-period moving averages, but we're still positive here. So we're working off of this study where we set a minus, or we went under 10 with the reading, and then within a fairly quick period of time, we're able to shoot above 70. This is more like what happened in March of 2023, where we had a negative reading, shot up, and then you can see what the market did after that. We don't know if it's going to play out this way, but we do have some precedents here. Stocks above their 50-day moving average did decline, but still above 50. So that's positive. We also declined with the 100-period moving average steady and slightly down below 80 with the 200-period moving average steady, but still showing good solid strength. The Copic curve is still positive. The Sean trend meter is positive. Standard deviation has been dropping as the market's been slowing down over the last few sessions. Probably when we drop, or if we drop below the moving average here, I'll stop showing this chart. The Pring bottom fisher is still working off of a buy signal. And the mass index, again, I'm not really sure what to do with this. Maybe this ended up being some kind of a buy signal, even though the context for how this signal was triggered meant that we were going up at that time. But this is becoming less and less relevant as we're moving away from this signal that had been triggered. We are positive with the Heiken Ashi. We're positive with the Kegi. We're positive with the Renko. We're positive with the 3-line break. And we're still looking quite positive with our 150 and 200 period moving average study. We're positive across the board according to the Keller market model. We're also positive in the short term with bonds based on price. We're still seeing a short-term decline with the US dollar index. And they finally changed this, but they posted or predated it. Or what's that when you backdate? I guess backdated. They kicked it back to May 6th. So obviously this does not change automatically. Somebody has to come in here and do this. But we're positive in the short term according to the decision point scorecard, positive in the mid, or they call it midterm. I say intermediate term, and we're still mixed in the long term. Nothing but blue or green here. The Dow did set an all-time high. Now it closed off of that. This was earlier in the day, but the industrials, which had been seeing some weakness, now crossed back above 70. The NASDAQ also set another all-time high. So things are continuing to be quite positive. Here's the sector chart just for the day where tech was up the most, followed by communication. These are the two stronger areas. This is more growth. If we can see these continue to follow through day after day, this would really help our growth to value ratios to improve. And looking at the equal weight, not a big change there other than since the mega caps did outperform, we saw this going up, but we're not seeing any real conviction pretty much for all of 2024 with this particular study. The Dow did set an intraday all-time high, but ended up being down about 0.5%. The diamonds continue to be neutral for the Elders Impulse system. We are setting another new all-time high with the NASDAQ and also a new all-time high with the NASDAQ 100. But we continue to be neutral with the Elders Impulse system for the Qs. The momentum for the NASDAQ 100 is continuing to be positive. And we're starting to see a cross here. This is also positive with the 20-period moving average crossing back above the 50. As long as price can stay above this, that's going to help these moving averages look even more positive. The small caps, yeah, at the high end of their range, so they had to decline, not by very much, just down 0.08%. But if we really start to drop, that's kind of what we've been seeing. What we're waiting for is to see if we can break out above this 2024 range, which also kind of matches up with previous high ranges that we see on the chart. We continue to be neutral with the small caps when looking at the Elders Impulse system. When we look at the Russell 2000 small caps, still looking good as far as the RSI. We're still above the 50-day moving average, and the momentum continues to be positive. The mid caps were up slightly. We're still above this R1 pivot level for right now. But we continue to be neutral with the mid caps when looking at the Elders Impulse system. Apple was up 0.62% and still above its 200-day moving average. We're starting to see the 50 period turn back up, but we're still in a downtrend. Tesla is also in a downtrend and was down 1.41%. Now, NVIDIA is kind of the big story this week. Their earnings are going to come out Wednesday after the close, and if they blow things out of the water like they did last time, this could really give a, a real support to the market. But if they come in not as the market has expected, that could really drag things down as well. Microsoft is above its 50-day moving average and was up on Monday. Meta was down, still having a hard time getting back above its 50-day moving average. Amazon was also down, but still above its 50-day moving average. Google was up 0.5% and going back and setting all-time highs now. Netflix also breaking out and not back to all-time highs yet, but still looking pretty solid here. The FANG index setting a new all-time high. Financial sector was down, but still above the 50-day moving average. Some of this probably had to do with the pullback we saw in JP Morgan Chase. And we're looking at the staples to tech ratio. This is now starting to go back down. And that's what we want to see if we're going to be more positive with the tech sector. The dollar was up slightly. It's still in a longer-term uptrend, and that pressured stocks a bit. Looking at the S&P 500 and then the world index, short term, they have a pretty strong relationship. When we go a little bit further out based on 50 periods, this is showing a little bit of strength here. And I have another new chart. This is just the SPY with a ratio to the ACWI ETF. And when this is going up, that just means that the S&P is outperforming world stocks. The staples sector was down, but still has been in a pretty solid uptrend. This is one of the more defensive areas that we're keeping an eye on. And utilities were down slightly, but they've just been screaming to the upside as well. This is also a defensive area that we've been watching. When we look at the total U.S. stock ETF, we were up slightly and setting, I believe that's another new all-time high. We were up with the 10-year yield. We were down with the 10-year based on price. And we want to see this ratio continue to decline. This is showing the bonds are underperforming stocks, and that would be more advantageous for stocks. Well, we're continuing to go up here with the S&P 1500 with shorter term bonds. And then looking at another broad market measure with little further out bonds, also continuing to go up here. And when we look at the Qs to the 3 to 7 year bond, this is continuing to go up also. So things are hanging in there. When we look at it on a stock to bond ratio, the tech sector also looking good when compared to bonds. And then the market is still going up, anticipating that we will have a soft landing by avoiding a recession. Want to keep an eye on this. This is ticking back up. We want this to go down. When we look at cash versus 3 to 7 year bonds, this is still in an uptrend. If this could continue to decline, that would be more positive. And then looking at the growth to value ratios, seeing a little bit of an improvement to Qs to the S&P, still going down with discretionary to the S&P, a little bit of a tick up when we compare large cap growth versus large cap value. So a bit of an improvement with the large caps, crossing back above a declining moving average with the mid caps, and also going a little bit further above a declining moving average with the small caps. We're still looking good here with our 10-day average of the S&P 500 highs minus the lows. We're still looking good here with our advanced decline ratio based on price and volume. But this is also a concern. The S&P to utilities ratio continues to go down. We want to see this going up, which is typically what happens when the S&P goes up. This came back down a little bit. The staples to S&P 500 ratio, we want to see this continue to decline to give more support to the S&P. So what's our outlook for Tuesday? NVIDIA will report earnings on Wednesday after the close. And so that's going to be, it's already highly anticipated, and it'll be interesting to see just what happens there. We are positive, but we're extreme positive when we look at our technicals. But as I always say, we could look at that in a negative way, suggesting that we need at least a pullback. We could look at it in a positive way, meaning that there's just solid momentum. We're not going to have any economic reports on Tuesday. And then the whole geopolitical thing, keeping an eye on the latest news coming out of Iran to see if that escalates into something. Here's our economic calendar, where on Wednesday we'll get the FOMC meeting minutes. We're going to get jobless claims on Thursday. And then Friday, we're going to get durable goods and consumer sentiment. And then Jerome Powell's going to be speaking at right after the market closes on Tuesday. So that may impact the futures, but it'll be after the market closes. Seasonality, we're neutral to negative with the Dow and S&P, where we're neutral to positive with the NASDAQ. So no real edge there. We are still in the week after options expiration, where we tend to be up more than down. But last week, we tend to be down more than up, but we had an up week. Looking at our seasonal chart here, where we're coming down just a little bit with the green dashed line, but then we do bounce up from there going into the 16th day of the month, 16th trading day. But Tuesday is kind of not really that committed either up or down based on what happened in 2023. Here's an updated chart here. This is showing what the S&P has been doing. And then they really reworked this thing to say, okay, what are we going to compare it to? And this is when the sitting president is running, if you take out 2020. All right, that's the blue line that we're kind of following now, where in May, we do see some weakness going into the latter part of May, but we're coming up into the end of May now, getting near Memorial Day. And then it's typically in June, July, and August, and even into September when we see some good solid strength during an election year. We'll see how closely it plays out this time. We're still in that latter, or in the latter part of the negative period, according to Tom Bowley's research. So the warning signs, the mass index, and I don't know. It's as we keep going day after day after day, I feel that this signal is becoming less relevant. And then we're keeping an eye on staples and utilities. From a textbook standpoint, that's a warning sign. But as the research that I showed in previous videos, according to Jason Gephardt, looking out further, 6 to 12 months, that is not necessarily always negative. In fact, 10 out of the 12 times, we ended up being positive. And growth to value, as well as discretionary to staples, they're not, I mean, they ticked up a little bit, but what's going to happen from here? We need to see more follow through with that. And then we have our whole list of positive things here, pretty much across the board with our indicators. And then our conclusion is that we're positive now, and I haven't really changed this, but we're still extreme positive. Whether you want to take that in a positive or negative way is up to you. Right now, it's looking like just good, solid momentum. We see that in the short and intermediate term, and we are also still positive in the long term. Thank you very much. I really hope you found this video helpful. I hope you have a great day, and I will talk to you in the next video.